Right, well, let's welcome Mahesh Patil, Chief Investment Officer, Aditya, Birla, Sun Life, AMC, who joins in. Hi, Mahesh. Good morning. Good to see you in. Markets appear to have got its mojo back and in style. Now the street is talking about, higher highs and, in fact, moving on in the upward trajectory. What do you think? Euphoria, or do you think that it's very realistic? I think earnings is going to be the key determinant, and we'll get a sense of that in the next couple of weeks. But how are you feeling with regard to the Indian markets as of now?
Yeah, good morning. I think some of the headwinds or the clouds which were lingering around, right, on the geopolitical side, as well as on the tariff front, I think those are kind of now moving away, and that is giving a comfort that I think the risks which were there are kind of coming off, and you've seen that not only Indian markets but even the global markets. I mean, U.S. market is now almost close to its all-time peak now, right, where in fact, there's a bigger concern, right, in terms of slowdown in growth because of the tariff impacts. So I think that is, now kind of behind, and overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady, and I think valuations were reasonable. I mean, markets after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective, but even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is Muda, but clearly, I think the confidence is coming back. And as we step into this fiscal year, we would see that the overall trajectory of growth, at least on the earnings front, should be better than what it was in the last fiscal year. More so in the, I think, second half, while the first quarter could still be a bit tepid because there has been some uncertainty on the global front. Companies have been doing a wait and watch. But I think clearly, with good monsoons also now coming in, we're expecting the sowing season has been good. So rural economy should do well this year, no? And that should support some amount of consumption also, which has been kind of lagging behind.
There's consumption which is likely to do well, sowing season, which implies that a lot of the domestic-facing names are likely to do a lot better. But, Mahesh, I wanted your views on the IT space, because that is one index which is still a fair distance away from its 52-week high at a time when all the other indices are fairly close to their highs. Do you think the weakness is priced in and global situation is looking a lot less cloudy now than what it was, say, same time last year?
I would guess so, yes. I think the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And it looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter. And that should support. So I would say that this sector is now looking, while the stocks are not cheap, especially in the mid-cap and the small cap space in the IT is still expensive relative to the historical numbers. But I think clearly the headwinds there are behind. So I think if there is any positive surprise or slight change in the commentary, I think the stocks are probably ready to bounce from these levels.
So if you had to construct a portfolio, Mahesh, could you give us a broad sense of how you would do it with the preference and then the allocation to each of the sectors or themes?
So I think the allocation would be preference would be more towards domestic plays because global uncertainty, I think on the tariff front, while we've seen that, I think that might still prevail for some time. So domestic plays, especially as I said, the focus on the rural consumption. So we've seen that even some of these agrochemical companies are likely to report very good numbers in this quarter because volume growth has been strong. But as we move forward, right, we should see some of the discretionary consumption, especially as we move into the festive season, should do well. Rate cuts have happened, and we've seen the transmission of that happening pretty fast, and that should help some of the interest rate plays, especially say if you're looking at banking and financial, then the financial services, and the NBFCs in particular, I think should see a better growth not only but also improvement in the margins over there. So by and large, I would say a domestic focus, and on the external front, I would say sectors like say IT, for example, which have already underperformed and factoring a kind of so I think they could be a kind of a contra play to look at.
All right, the big story really, Mahesh, which has given confidence, particularly on the macro front, has been the sharp fall in crude oil prices, and it's continued. There's no big view that's come in that crude oil prices are going to dance away to 100 anytime soon, even though we have geopolitical issues that cropped up. In that sort of a backdrop, what's your take on these OMCs? They appeared that at least as of now, valuations are in favor, crude oil prices are lower. How would you play this fall in crude oil prices? Will it be the OMCs? Will it be the paint companies because they stand to benefit, or would it be the FMCG names?
Yes, you're right. I think even with the worst of the, tensions which were there, we saw the crude price didn't go above $80 or so, right? And now with those things behind, I think the pressure on crude oil is fairly evident, and it looks like it will remain at these levels, right, around $60 or so. So given that, I would agree that the oil PSUs, oil marketing companies, are likely to see a better kind of marketing margins, although the refining margins have also actually improved a bit. So I think all in all, I think the outlook there should look better. But I think you should also look at, while crude oil prices have come down for the other sectors, it's also important to look at the demand side, okay, how that is shaping up, because unless the demand picks up, you will not see the benefit of crude price really coming in. Otherwise, they have to pass it on to the end consumers. So, but I think across the board, I think the inflation and this thing basket, I think should be lower. So I think that's good. And even the macro, I think it is more important, right? Because we've seen that this last month, after many years, we've seen that the current account deficit, right, was in surplus. And that shows that it's a combination of not only crude oil prices, but also on the export side, remittances and this thing were also good. But I think that places India in a much more comfortable macro situation for stability. And that means good for flows, foreign flows into the economy.
All right, just look at Reliance. The stock has recovered a fair bit from the lows and actually taken the Nifty back into the green as well. It was mildly below the flat line at open for Reliance as well as the Nifty. And if you pull up both the intraday charts of the Nifty and Reliance, you would know that they're fairly strongly correlated right now. Reliance has been leading the gains on the frontline index. Right now, it's recovered from the lows, and that's taken the Nifty back into the green as well, slightly above the flat line. I wanted your thoughts in particular on the consumer discretionary space, Mahesh, because a lot of people believe that urban weakness is also now bottoming out, and from here on, discretionary would do a lot better than staples, because that's where a lot of the incremental income would be deployed. So in light of that, say hotels, Eternal, and a lot of these other new age companies, would you back them at these valuations?
I think the discretionary consumption again was weak last year. It is recovering. Still, the trends are not really very strong, but I think the two things. One is the rate cut, which should start, the transmission should start through, and that will mean that your disposable income could be higher. Secondly is the kind of a tax breaks which were given in the budget, right, for 1 lakh, total amount which has been passed on to the taxpayers. I think that will start to now flow in, and that will help the rural urban consumption, I would guess. So I think, as I said, mostly I think you should see the impact of that coming in into the second half, where it should gather momentum. And rural consumption is, as I said, with good sowing season, rural wages are in positive territory. Real wages are doing well, slightly than what it was in the last 2 years. So that should also spur. So I would say that consumption, especially discretionary consumption, retail companies, consumer durables, and the likes, I think could pick up. But it will take time. It will not happen in the first half. I think you'll see that impact more in the second half.
What do you expect from banks in this earnings season? Because the latest reported system loan growth has been subdued. I think as of 13th of June, the loan growth was sub 10%, 9.6%, which is lower than the FY25 level. And plus, there will be the NIM compression that we will see on account of the rate cuts. So what's your expectation from banks? And if there is some weakness, would you go out there and add to any financial stocks? And where would your preference lie in financials?
Yeah, so banks this year, the outlook for overall growth is a bit muted in high single digits because, as I rightly said, because of the rate cut, you'll see an NIM compression. But I think there is some benefit coming in because of the overall CRR cut also. So the impact is not as high as one would have expected, considering that we have seen a 100 basis point rate cut, in the last 6 months, 9 months. Having said that, overall loan growth is, I think, the bigger challenge, as I rightly said, is in terms of the loan growth. In fact, last year, the concern was on the deposit side. Deposit growth was weak. I think that is now improving with overall system liquidity looking better. And banks have also been able to now cut rates, deposit rate much faster. So that should also help on the liability side, though the impact will take time to percolate through. So overall, I would say that the loan growth is the bigger this thing. I think and for that, I think we'll have to wait and see how the recovery happens, both on the retail side and on even the corporate side, because of the uncertainty. I think we've seen the corporates have been slightly hesitant in terms of pursuing with some of the capex plans. But as we get more clarity on the global front, I think you will see that also pick up. I would say that banks look good. Short term, this quarter, there could be slight, the profit growth would be slightly weaker, but I think one should really buy into this. We don't see any major structural challenge in the banking space. Continue to prefer the private banks. I think, though PSU banks are also looking good now because we've seen them underperform recently and the valuations there are fairly comfortable. But again, they would be more cyclical play rather than structurally. We'll still prefer the private banks.
All right, we take that point. Thanks a lot, Mahesh, for joining in and chiming in with your view on the market, the economy, individual sectors, and how they're likely to perform from here on. Seems like maybe the second half of this year a lot better given the favorable macros. The one